going to be not affected to the same extent. So what do we do with all that? So when we sit down and we do a review of our client's file, we take a look at it, we have 4 basic questions that we ask. And that is, are they in a high income situation? Are they 65 years or older? Is education planning and funding a part of their overall plan? And what does their portfolio look like? So when I talk about what the portfolio looks like, I am not even looking at the investments within it. That's a secondary look. Of course, we care about that, as Jim talked at great length about the investments and what we think about how the portfolio should be invested in terms of the investment vehicles. But for the purpose of year-end tax planning, when I'm talking about portfolio compositions, are what types of accounts? Are there after-tax accounts? Are there IRAs? Are there Roth IRAs? Any annuities? What types of accounts? So what does the portfolio have from that perspective? So I'm going to jump into an example here of the Ritchie family. So their annual income is about $300,000. It's a husband and wife. They're both in their late 40s. They have 2 teenage daughters, ages 13 and 15. And their portfolio, their total portfolio is $1,050,000, and it's comprised of $400,000 of a rollover IRA, $100,000 in a Roth IRA, $50,000 in education savings accounts, 529s, and they have $50,000 in an after-tax brokerage account. That after-tax account is generating about $30,000 in portfolio income, and it has an embedded capital gain of about $60,000. It's an unrealized gain. So in looking at the Ritchie situation and starting to think about their tax planning, what we note is that they're high income, education is a part of their plan, and we have some opportunities within their portfolio. So the strategies over off to the right-hand side of this slide, I'll kind of run through a bit of the strategies that we'll be looking at for them, and that is focusing on income shifting and how we can reduce their income to get them below the thresholds of perhaps being subject to the Medicare 3.8% tax on their portfolio, or just any way that we can help offset some of the higher tax that affects the higher income earners. And I'll take a quick tangent and note that most of my conversation here today, or almost all of it, is related to the federal tax. But if you live here in California, there's also some additional benefits to lowering the taxable income and getting that down under $250,000 here in California. Many of you know that we just passed Proposition 30, which levies an additional tax on those earning over in excess of $250,000. And that begins in 2013. So that's yet another reason. We want to take a look at and make sure that to the extent it makes sense, kind of a big obvious duh, we want to make sure that the 401ks are being fully funded. And then we'll also take a look at the IRAs. Obviously, the Ritchies, because of their income, wouldn't be eligible to make a direct contribution to their Roth, but in a moment I'll talk a little bit more about indirect Roth contributions. That might be an area that we can do some good work for them. Also, on the income shifting, where does that $300,000 of annual income come from? Is that wages, or is one of the earners a sole proprietor? If they're a sole proprietor, there's some great work that can be done with regard to the children and the education funding by paying the children So you know, each of the kids will have some tax capacity at a much lower tax rate. We have to be mindful of the kiddie tax rules, but there is some capacity there, and there's some good work that we can take a look at. With regard to the portfolio allocation, looking at Roth conversions, you know, especially in this year in 2012, does it make sense to do any type of Roth conversion? And the notion, just, you know, kind of in summary and overly simplified, but to the extent that we can get money out of that taxable portfolio and into a Roth environment, it definitely makes sense. And there's a lot of math that goes behind that, but that's definitely one of the strategies we take a look at. Of course, we might want to take a look at that $500,000 also and see if it makes sense to do any 529 funding, increasing those balances. You know, there's some things to be aware of there. Does that make sense? And in some cases it does. If you're sure that you want to pay for the children's education 100%, but if you're not sure, then a Roth is likely a much better option to go with. And of course, you can always look at gifting to the children and just gifting to them outright. One quick tangent I'll make here is that we do some very extensive education planning, and related to that, in a high-income situation, it would definitely be worth a conversation to talk about gifting to the kids, and if that makes sense. We wouldn't be talking about that perspective and strategy if we were a type 2 family or a family that's not considered high income. So lastly, one of the things that we keep in mind in this situation is we'd want to be mindful of capital gains loss harvesting. And what that means is, does it make sense to go ahead and recognize those gains this year, given that we have a much lower tax structure on capital gains versus what we're looking at next year? And it's likely that that's the case. But again, those are some of the things that we take a look at. So my second example is Mr. and Mrs. Leisure. And their annual spending is about $180,000 a year. That's supported by $70,000 in pension income, $60,000 in Social Security, and they're taking a draw from their portfolio of $50,000. Now, note that I'm not talking about their income here, because it's a much different situation when you're in retirement, and we take a look, we anchor on spending. That becomes much more of an important focus when we're talking about retired clients. So as you can see that they're age 66 and 64, they have no children at home, it makes sense. And their total portfolio is $2 million, consisting of a $1 million rollover IRA, $200,000 in a Roth IRA, and $800,000 in an after-tax account that's generating about $100,000 in portfolio income. Wow, that's a great rate of return, isn't it? In any case, these are hypothetical examples. And it has about a $60,000 embedded capital gain. So for the Leisures, our tax planning, what we're going to do is we're going to take a look at what is their tax bracket. Going back to that tax table that I showed you just a little bit ago, they're likely going to be in the 25% tax bracket. And so they're likely going to have some headroom. And by that, what I mean is, you know, the upper end of that tax bracket, if I remember correctly, is somewhere in the neighborhood of $160,000. And so if their taxable income is at $130,000, well, then they have $30,000 headroom before they jump up into the 28% tax bracket. It may make sense for us to go ahead and do a Roth conversion of that $30,000, use up that headroom, and put money into the Roth so that in the future we can perhaps keep them down in a lower tax bracket, or if they have some big expenditure that comes up, that we're going to be able to more effectively utilize their portfolio and not trigger big tax draws from should they need a big distribution. And it also allows us to start working on reducing that after-tax account and putting it in more favorable, tax-favorable types of accounts. The things that we want to keep in mind in that situation are medical premiums, or Medicare premiums. I showed you the table where the adjusted gross income has an effect on what you will pay for a Medicare premium. And of course, we want to take a look at the capital gains and losses and think about, does it make sense to do some matching up there. So the last family that I'm going to talk about is the Smith family. Their income is about $150,000. They're a husband and wife in their late 40s. They have 2 daughters, ages 8 and 10. And their portfolio is $100,000 in a rollover IRA, $20,000 in a Roth, $20,000 in education savings accounts, and $30,000 in an after-tax account that's generating about $6,000 in portfolio income and $6,000 capital gain embedded. So the strategies that we would take a look for them, again, of course, we want to take a look at the Roth, the 401k deferrals and make sure that we're using those. On the portfolio allocation, we want to take a look at, does it make sense for them, because they can contribute directly to a Roth IRA, should they go ahead and make those? Even if they don't necessarily have the tax flow from their income, we can take the contributions from this after-tax account and use that to fund their contributions. So with this type of family, we definitely want to be careful with the types of accounts that we're using, because in education funding, this family may be eligible for some free monies, federal grants or low-cost loans, and so we want to make sure that we're positioning their portfolios so that they're in the best position possible, and of course the gains and loss matching. So again and again, I've referred to the Roth IRA, and I thought it would probably be worthwhile for me to take a moment and tell you why we like the Roth IRA so much. And that is because, as I mentioned just a little bit ago, that once the money's in the Roth IRA, it is tax-free. It gets to grow tax-free. You don't have to pay tax on the appreciation, whereas like an after-tax account, of course, you're going to be paying portfolio taxes on the portfolio income it spits out. And when you take the money out of the account, it's not taxed. It's not subject to income tax. Once you make your contribution into the account, and it's been in there for 5 years, you can take the money out tax-free, the contribution, the amount that you put in, tax-free and penalty-free. You don't have to be 59.5. You don't have to have any sort of qualifying reason like hardship or education or medical. You can just take it out after it's been in there for 5 years. I talked a little bit about our approaches. Our approach to conversions. We like to fill up the tax brackets. Sometimes, if you're in a low tax bracket, the last couple of years, if a client's been in the 10 or 15% tax bracket for whatever reason, we've filled up the 15% and had some really great conversations about, does it make sense to tread into the 25% tax bracket. So that again becomes a conversation, a one-on-one conversation that we have during our meetings. So the annual contributions, you can make an annual contribution if your AGI is 107,000 or less and you're filing single, or 169,000 if you're married filing joint. The indirect, that works really well if you have, if you don't have a traditional or deductible IRA. So for example, if we have a client who has $100,000 in an after-tax account, it's spitting out portfolio income that is really starting to, we're worried about how it's going to be taxed in the next few years. All of their retirement assets are in their 401k. They do not have any type of a rollover IRA or a traditional IRA. Well, then what we do in that situation is we go ahead and just open up an IRA, make a non-deductible contribution, and then automatically convert it. And it's as if you were making a direct, just direct contribution to your IRA. So that's a really great planning tool for those who have, good income and all their retirement assets are in their 401k. So to, wrap it up on the Roth 401k, the Roth IRA, we see them as wonderful education funding planning tools because they are so flexible. You can take the money out after it's been in there for the 5 years, use it for however you like. You can take the earnings out for education. You do have some no penalties, but the earnings would be included in income tax. But it's just a great tool for education planning for a lot of reasons. And then income tax management in retirement, and I talked a little bit about those thoughts. So just a couple last little things I wanted to make sure I threw out there. The threshold for deducting medical expenses, right now there's a floor, so to speak, so 7.5% of your AGI, your expenses, medical expenses beyond the 7.5% of your AGI in 2012, you can claim those as a tax-deductible expense. Next year, that floor is going to 10%. The child care credit is scheduled to expire in 2012. So some of the most common tools that we use here at Lighthouse is the capital gain and loss analysis, the Roth contribution conversion, education planning. We can do a lot with that, and then the income tax planning and retirement. And one strategy I haven't talked about, and I'll just briefly describe it here, is the we want to maximize the gap years, and those are typically the years between when you start receiving Social Security. That can be as late as 70 in some cases, maybe 66 or 67 for some of you. But if for some reason you're not taking Social Security and you're not in your required minimum distributions for your IRAs, that can be a great opportunity for us to look at how to maximize the Roth conversion. So that concludes all of my prepared comments, and we'll go ahead and open it up and see if anybody has any questions. Not seeing any questions. So with that, Jeanette,